Debt, a tool or a ticking time bomb? It helped billionaires build empires and tore companies apart. Today we're talking about LBOs, leveraged buyouts, and why they're either genius financial engineering or corporate sabotage in disguise. An LBO or leveraged buyout is when someone buys a company using borrowed money. A lot of borrowed money. Think of it like buying a house with a mortgage. Only the house is a company and you're borrowing against its future to own it now. In most cases, the assets and cash flows of the company being bought are used as security to borrow the money. Yes, you heard that right. You borrow against a company before you even own it. Nowhere has the dark side of LBOs been more public than in football. Manchester United fans blame the Glazers' LBO for years of underinvestment, on-pitch decline, and a mountain of debt loaded onto the club. Critics argue LBOs turn healthy, debt-free companies into over-leveraged cash machines, draining profits to service interest instead of reinvesting or protecting jobs. Take the infamous RJR Nabisco deal in 1988, the largest LBO at the time. Crushed under debt, it couldn't cut prices, couldn't innovate, and eventually it fell apart. There's a moral argument too. Some say if you want to buy a business, use your own money. But LBOs reduce personal risk for the buyer and shift it onto the company being acquired. Plus, here's the kicker. Interest on debt is tax deductible. That means less tax paid to governments and more money going to lenders. But you could argue that lenders themselves pay tax on that income, right? But hold on, LBOs aren't just a wrecking ball. In the right hands and with the right business, they can work. If a business has stable cash flow and predictable revenue, leverage can be managed. Just like a mortgage, as long as you can cover your payments, it's not reckless, it's strategic. LBOs also help buyers meet a seller's asking price and expand the pool of potential acquirers. If everyone needed millions in cash to buy a business, far fewer deals would happen. The key? Headroom. The company must have enough breathing space in its cash flow to handle repayments, reinvestment, and downturns. And remember, banks don't like losing money either. They won't lend for an LBO unless they're confident it can be repaid. So are LBOs evil? Not necessarily. They're powerful tools, but like all tools, it depends who's holding them and how they're used. If you enjoyed this video, don't forget to like, subscribe, and share your thoughts below. Are LBOs smart business or financial vandalism? Let us know.